Jake and Marcus, two individuals in the prime of their financial lives at 28, share startlingly similar financial landscapes. Both earn $55,000 annually and grapple with identical debt burdens: $22,000 in student loans at 5.5%, $14,000 in car loans at 7%, and $6,000 on a credit card at a debilitating 22% interest rate, totaling $42,000. They each navigate life with a modest surplus of $600 a month after basic necessities and minimum debt payments. Yet their strategies for this remaining capital diverge sharply, each driven by a different philosophical stance on money. Jake, a disciplined, adheres to a recognized financial plan, often described as a path focused on elimination, decides to tackle his debt with intense focus. His approach, a structured and behavioral strategy, involves dedicating every extra dollar to paying off the smallest debt balances first, regardless of the interest rate. The logic isn't about the mathematics of optimization, but about the momentum and psychological gratification derived from achieving small, tangible victories. By eliminating a small debt, he feels a sense of progress, empowering him to attack the next challenge with even greater fervor. This philosophy prioritizes behavioral change and consistency over intricate financial calculations. Marcus, on the other hand, embodies the modern-day internet-influenced financial enthusiast. His perspective is that money, if invested rather than used to prepay low-interest debt, can yield greater returns, creating a wider margin of wealth over time. He aims for a theoretically optimal portfolio by consistently investing his $600 into an index fund tracking the S&P 500, historically known for a 10% average annual return. His rationale seems sound on paper. Why allocate extra cash to debts with a 5% to 7% cost when those same dollars could potentially grow at a much higher rate in the market? He feels comfortable maintaining minimum payments, seeing it as a minor inconvenience for a potentially much larger payoff down the line. During the initial years, Marcus's strategy appears to be a clear success. After 2 years of disciplined monthly contributions, coupled with compound growth, his investment portfolio has surpassed $16,000. He takes pride in seeing his balance steadily rise, feeling a sense of control and foresight. Simultaneously, Jake is living a somewhat restrictive lifestyle, having picked up a side gig and directing every penny to his debt. He's made significant progress, knocking out the credit card in less than 8 months and launching a focused campaign against the car loan. A review of their net worth at the 2-year mark reveals a nuanced picture. Marcus boasts a portfolio of $16,000 against remaining debt of approximately $34,000, leaving him with a net worth of $18,000. Jake, while having zero invested, has slashed his debt to around $19,000, resulting in a slightly higher net worth of $19,000. The difference is minimal, yet it challenges the notion that Marcus's approach is definitively superior in the short term. Marcus's paper profit of $1,000 is often viewed as a trade-off for the ability to live a more typical lifestyle, going to restaurants and maintaining social engagements, while Jake's laser focus on debt elimination is seen as restrictive. However, the true nature of Marcus's plan is revealed when the long-term reality of carrying high-interest debt is considered. While investing $600 a month in the S&P 500, Marcus is paying roughly $110 in interest monthly on his credit card alone. This is a guaranteed loss that compounds with time, regardless of the stock market's performance. Essentially, a significant portion of his potential investment returns is being eroded by the interest cost of his debt. Furthermore, his blended interest rate across all three loans sits around 9 to 10%. Once taxes on his investment gains in a taxable brokerage account are accounted for, his after-tax return is effectively closer to 7 to 8%. The difference between his borrowing costs and investment returns is razor-thin, and on the credit card, he's actively losing ground. A crucial caveat where Marcus's approach holds significant merit is the opportunity to maximize an employer-sponsored retirement match. Many financial advisors, including those associated with traditional elimination plans, emphasize the power of taking advantage of a match, as it represents an immediate and often substantial return that can outpace debt costs. In this specific situation, Marcus could argue that maximizing the match before tackling debt is indeed the most financially prudent choice. Yet, Marcus is investing his entire $600 surplus into a taxable brokerage, indicating that he is motivated by high-yield growth, even as he services high-interest debt. This highlights a potential issue of overconfidence, dressed in an optimized investment spreadsheet. As the years progress, the divergent paths yield significantly different long-term results. 34 months into his journey, Jake completely eliminates his $42,000 debt. This transforms his financial situation from that point on. Jake is no longer bound by monthly obligations to multiple lenders, liberating his entire paycheck. He's now armed with his original $600 surplus, along with the approximately $850 a month that was going towards minimum payments, providing him with a substantial $1,450 to invest each month. Let's fast forward to the 10-year mark. Marcus has consistently invested $600 a month and finished paying off his debts on their original schedules. His credit card was paid around month 40, his car loan by year 5, and student loans by year 8. His final 10-year portfolio value is between $140,000 and $155,000. In contrast, Jake invested $1,400 a month for only 80 months, after needing time to build an emergency fund, and ends up with a portfolio worth between $165,000 and $175,000. Jake, the non-investor for the first 3 years, has achieved a higher net worth than the consistent long-term investor. This surprising result is due to 2 critical factors. First, Jake avoided incurring a significant amount of interest cost by prepaying his debt early, saving himself between $12,000 and $18,000. This money was then channeled into investments instead of enriching lenders. Second, once debt-free, Jake's monthly contributions were substantially larger, accelerating his portfolio's growth via compound interest. Even with a 3-year head start, Marcus's smaller contributions could not keep pace with Jake's massive, freed-up cash flow. However, the calculation relies on a potentially unrealistic assumption that Marcus would be a perfect, unemotional investor for a decade. In real life, individuals often succumb to human impulses, buying high, selling low, pausing investments during volatile markets, and reacting to sensational headlines. A J.P. Morgan study revealed that while the S&P 500 returned 10% annually over a 20-year period, the average investor earned only 3%. This massive gap illustrates the substantial gap between theoretical optimization and practical behavioral pitfalls. Jake's plan, which focused on debt elimination, was psychologically robust because it eliminated the possibility of making poor decisions in a volatile market during those crucial first 3 years. He had zero exposure to stock market fluctuations and was instead making permanent, guaranteed progress by paying down principal. For him, it didn't matter if the market was thriving or crashing. His progress was certain. In contrast, Marcus's plan required him to maintain rigid consistency and avoid emotional decision-making for a full decade, a difficult feat for any human investor. The crucial point that standard mathematical arguments miss is behavioral control. Traditional financial plans emphasize eliminating consumer debt, a concept often described in behavioral rather than mathematical terms. The plan's success hinges on its ability to remove the single biggest risk to a person's financial future: their own behavior. If a person can maximize their employer match while aggressively tackling remaining debt, that combination can be highly effective. Similarly, if all debt is at a very low interest rate, below 5%, the case for investing instead of prepaying is much stronger. However, most individuals fall into a gray area between 5% and 7%, where a decision depends on individual discipline, tax circumstances, and ability to remain consistent through varied market environments. The real trap lies not in prioritizing debt elimination, nor in prioritizing investment, but in making crucial financial decisions based on oversimplified rules of thumb or internet rhetoric. Individuals should carefully run their own numbers based on their unique interest rates, tax situations, and an honest assessment of their investment discipline. Because at the end of the day, the best financial plan is not the one that looks most optimal on a spreadsheet. It's the one you can actually commit to and complete over the long haul.